What if I told you the biggest financial system in the world doesn't actually run on money? It runs on belief. It's the moment people stop believing, banks collapse, markets crash, and entire economies freeze overnight. And history proves this has happened before. Welcome to the Financial Historian. For most of human history, money was simple. Gold was money. Silver was money. Value had weight. You could hold wealth in your hand. But modern economies operate differently. Today, almost 90% of money doesn't physically exist. It lives as numbers. It's inside banking systems. And that change quietly transformed power itself. The moment money changed forever. In 1913, something happened in the United States that most citizens barely understood. The creation of the Federal Reserve. Officially, it was designed to stabilize financial crises, to prevent bank runs and economic panic. Unofficially, it changed who controlled liquidity. Before central banking dominance, financial crises were brutal but short. Banks failed quickly. Markets reset violently. After centralized monetary control, crises became manageable, but also larger, because stability created confidence. Confidence encouraged risk. The hidden engine of growth. Modern economic growth depends on one thing: credit expansion. When banks issue loans, they don't transfer existing money. They create new money. A mortgage creates money. A business loan creates money. Even your credit card swipe creates temporary purchasing power. Debt became the fuel of prosperity. And for decades, it worked. Homes expanded, corporations scaled. Consumption surged. Economic growth accelerated faster than any period in human history. But growth powered by debt carries a silent condition. Tomorrow must always be bigger than today. The problem nobody wanted to see. By the late 20th century, economies faced a paradox. Growth required borrowing, but borrowing required confidence in future income. So policymakers discovered an uncomfortable truth. If growth slows, the entire debt structure becomes fragile. Recessions were no longer natural corrections. They became systemic threats. Because too much of the economy depended on continuous expansion. The psychology of modern money. Here's something rarely discussed. Financial systems are psychological systems. Markets rise not only because profits increase, but because expectations increase. People buy homes believing prices will rise. Investors buy stocks believing others will buy later. Banks lend believing repayment is certain. Confidence compounds, until suddenly, it doesn't. 2008, when belief broke. In 2008, the global financial system experienced a terrifying realization. Major institutions were not failing because money disappeared. They failed because trust disappeared. Banks stopped lending to each other. Credit markets froze. Companies couldn't finance operations. The system nearly halted, not from lack of resources, but lack of belief. Governments intervened massively. Trillions were injected into markets. Interest rates dropped near zero. And something historic happened. Central banks proved they could create liquidity almost without limit. The era of cheap money, after 2008, borrowing became easier than ever. Low interest rates encouraged investment. Stock markets surged. Technology companies exploded in value. Asset prices climbed worldwide. Cheap money has side effects. When money becomes inexpensive, assets inflate faster than wages. Those who own assets grow wealthier. Those dependent on income fall behind. The gap widens quietly, not through conspiracy, through mathematics. The new form of wealth. In the modern economy, wealth increasingly comes from ownership, not labor. Stocks, real estate, intellectual property, digital platforms. Capital compounds faster than salaries, and markets reward scale. Large companies grow larger because efficiency favors dominance. Network effects strengthen winners. Competition decreases. Market concentration increases. Efficiency improves. Equality does not necessarily follow. The central banker's dilemma. Today's policymakers walk a narrow line. Raise interest rates too fast? Markets crash? Keep rates too low? Inflation rises? Support markets too aggressively? Asset bubbles form. Do nothing? Recession spreads? Every decision carries consequences delayed by years. Modern monetary policy is less about control and more about damage management. Inflation returns. In the early 2020s, inflation surged globally. Supply disruptions, stimulus spending, energy shocks. Prices rose rapidly. Suddenly, the assumption of permanent stability disappeared. Central banks tightened policy aggressively. Borrowing costs increased. And once again, the system revealed its dependency on credit conditions. Growth slowed almost immediately. Because modern economies are leveraged systems, small policy shifts create massive effects. The invisible contract. Here's the deeper truth. Modern money works because society accepts an invisible contract. Workers trust salaries retain value. Businesses trust currency stability. Investors trust markets remain functional. Governments trust debt remains financeable. Break that trust, and systems unravel quickly. Money itself is not wealth. Trust is. The future nobody fully understands. Today, new forces challenge traditional finance. Digital currencies, artificial intelligence, automation, global capital mobility. Economic power is shifting again. The question facing the next generation isn't whether markets work. It's who benefits from how they work. Because financial systems optimize efficiency. They do not automatically optimize fairness. That outcome depends on institutions, policy, and ownership. The financial historian insight: history shows a repeating pattern. Every financial system solves the problems of the previous era, while quietly creating new ones. Gold limited growth, credit expanded growth, liquidity stabilized crises. But each innovation introduced new vulnerabilities. In understanding those vulnerabilities is the difference between participating in the system and being controlled by it. Powerful ending. The modern economy isn't a machine. It's a belief structure reinforced by policy, incentives, and expectations. And once you understand that, you stop asking only how money works. You start asking who designed the rules. Because financial history teaches one lesson again and again: the greatest risks are never the ones people fear. They're the ones everyone assumes are permanent. Subscribe to The Financial Historian, where money, power, and history reveal what headlines never explain.